Hey everyone, this is Ben. I do the All in the Reflexes Substack, and you can find me on Substack. You can find me on X posting charts throughout the week. I'll occasionally have updates on YouTube, but anything on YouTube is pretty much also on the Substack. So I want to go through what I'm seeing that is constructive in market structure, and then where I'm seeing reason to remain cautious. As a reminder, I share this stuff for educational purposes and as a way to record my own progress and thoughts on the market as they evolve. But nothing here is intended to be financial advice or trade advice, and certainly nothing geared towards anybody's specific situation or portfolio. But just want to get that out of the way, and then let's take a look at what we're seeing. So this chart has a combination of tools that I like to use for detecting early reversals, and really I use this in the context of uptrends. I use this indicator to try to find an equity that's reversing and going to participate in the uptrend. It's not intended to be a way to find bottoms in markets, but it did give me a signal on the S&P this week, and so I want to share that. So you've got on this indicator I have the MACD, and this is a volatility normalized MACD. It uses accelerated settings, so it's using an 8, 17, and 9, which is different than the typical 12, 26, and 9, and it's doing that to detect a bullish crossover early. And then on the bottom we've got, or in the middle, we've got the force index, and this is Elder's force index. It's a combination of volume and price, and applied to that I've got a 13-period moving average. And then I've also got a 5-period RSI on here, as well as a multi-time frame that combines the 5 and a 40-period RSI into an equally blended average. And so, what we can see is what I would look for in screening for a stock is a combination of the MACD signal line crossing 0 or the 13-period moving average crossing 0. That's usually the signal to join. But I'll also look for these crossovers of the MACD line and the signal line, and where the histogram for the force index is crossed over. That's where I find start to build a watch list of things to keep an eye on and see how their reversal is progressing. Is it failing? Is it is a downtrend fatiguing? Is it getting close? So so that gave us this signal on the S&P this week, where we've got positive movement on the MACD histogram, the signal crossover, and then you've got the force index coming up above 0. We also have on this 5-period moving average a bullish divergence, and this is over the past 5 sessions. So price is making a new low, and momentum is making a slightly higher low, and it's doing that with its 13-period and 33-period moving average curling and moving upwards slightly. And we look at the multi-time frame, RSI is very similar. You're making lower lows in momentum, because this includes a much longer view of RSI, but you have this detects the blue bar is detecting a bullish divergence among multiple indicators at the same time, and so that just gives us a signal to tell us, hey, look out, this could be a fatiguing trend and an opportunity in the near term. So put the drawing tools back on. Another thing that I look for in trends, and we've talked about this in the Substack and some of the videos, is a concept of a strong bar versus a against trend versus a strong bar in favor of trend. And so, as we had the reversal from the low last April, we had the most bullish bar in favor of trend, so going against the downtrend and establishing a new uptrend. This is like one of the most bullish bars that we've seen in the market in years, and so that sparks this big movement. But during the as we get more mature into this uptrend, we start to see strong bars against, where it's high volume, a large spread, the wicks aren't very long, and so our last 2 bars against, we can make an argument for these being our strongest bars against on the 12th of February, and then again on the 20th of March. And then last Tuesday we had our most bullish bar in favor of trend in several months. You could make a slight case for this one back here in March 9th, but again, this March 9th one, this is a decent decent spread, decent volume in favor of trend, and then you get weaker candles that immediately fail into a descending moving average, and that's a scenario we have to look out for here. We had this really nice reversal pattern with a strong bar in favor, or going against the downtrend and in favor of a potentially new uptrend, but you immediately are followed by a weaker bar, and then a wider session that dips back into the first third of that strong bar. So in a very strong bullish reversal, I would expect the bullish market participants to come in and defend the very top of this candle. It's still constructive that we didn't make it past the midway point, but at the open on Friday. But this is an area that bullish participants would come in and defend if we're truly in a bullish uptrend. So you've got these signals on our momentum indicators that incorporate volume in the middle that suggest that we've got at least the look of the earliest look of an end to the downtrend. And then let's take a look at what we see in the past. If you only get some of those crossing over, it's certainly less constructive than all three of them showing you something bullish at the same time, which is what happened at the very bottom of the low in 2025. We'll scroll back a bit more, and you can see you've got what's safest for me to follow into with these signals is the crossover of the MACD above zero. When the blue MACD line crosses above zero, and this 13-period moving average with the force index is above zero, that's when you're really getting past your downtrend and moving into a stronger uptrend. So that's more of what I'm looking for than these early crossovers to get for myself to get very bullish. This is enough for me to maybe consider a small position, and then start to build my watch list for short opportunities in case we see a failure like we did here. And you can see this is more likely to be the case when you've got descending moving averages and you've got participants jumping on these early opportunities. It's the cross above zero is where we had, even in the context of this downtrend, is where you had your most consistent short-term opportunities, right? So you still have a lot of downtrend coming here in 2022, and you've got this July movement where we get the MACD crossing above zero, force index's average is above zero, really nice look on the RSI, and then it fails, right? But this would have been a much stronger trade opportunity to enter here and have your stop loss at the 20-period moving average than if you were to say try to pick this low down here and then get chopped out a couple of times. You'd have to be really patient in a downtrend to try to take advantage of this bullish movement if you're jumping in down here. So that's what I see in that's both slightly encouraging, but I would lean more towards discouraging for a bullish outlook right now. We need to see more evidence, either more fatigue in the downtrend or some stronger movements to reclaim this moving average and push these momentum values up above zero. Now I want to take a look at Martin Pring's bottom fisher indicator and some unique ways that I tried to apply that this week. So first things first is Martin Pring has this bottom fisher indicator, and it's based on his indicator, the KST. And what he's doing with the bottom fisher is he's taking a measure of this KST for all 30 of the Dow stocks, and then he's just doing a category. And so he's got 4 categories based on the way that the KST is positioned. And so KST is 4 different rates of change with 4 different moving averages that are combined into a composite, and that gives us this really slow, or this really smooth this really smooth momentum indicator that doesn't have a lot of like these situations where you're getting whipsawed. We saw in this this MACD, like this is noisy, right? And these are helpful, but this is a lot of chop in here. This is not something that you can make good decisions with. You look at the same period. What is that, between August, the month of August in 2025? We're going to August 2025, and your KST is still just very smoothly moving upward, right? It's not trying to shake you out of the market like the others do. So he's got 4 categories that he uses as seasons, and so spring is when the KST is below 0, but it's crossed above its signal line, and winter is when it's below 0 and below its signal line. So you go, winter is the deepest part of your downtrend, into spring season, one of these less common fake outs here, and then you get into summer where you're above 0 and above signal line, and then fall. And in fall you're above 0 but you're below your moving average or signal line. So that's how the 4 categories work. And then he takes those categories and he's using them in the bottom fisher and only comparing the number of equities that are in spring versus winter. And so you're taking spring sessions, ones that are categories to spring, and you're subtracting the number of those that are in winter. And so when a lot of stocks are in either summer or fall, you're going to get that choppy middle. But once you've got a decisive movement that you're now moving heavily into winter and then heavily into spring, that's where it's trying to help us identify a bottom. Now, it's much better to find buying opportunities in the context of big uptrends. So you've got your 200 period moving average here, and you get a bottom fisher signal while you're below your 50 but above. You're below an inclining 50 and above an inclining 200. That's a good buy signal in the context of an uptrend. I don't use this as much for buy signals, but more for market, like personally profiling the market to see should I be looking for opportunities specifically in certain stocks. But so I've taken this concept, and he uses it with the top 30 Dow, or the 30 Dow stocks. I also apply it to the top 30 S&P stocks, excluding the ones that are also in the Dow. And then I apply it to the top 30 cryptocurrencies by market cap. And so his signal is, when the raw measure goes below -11, you get, a signal. And so I'm doing that with the Dow and with the S&P excluding Dow. And then for crypto, because it's so much more volatile, I'm doing 18. So you've got to have nearly 2/3 of the largest crypto in winter versus spring for us to get a reading on it. Individually, they're kind of choppy, and you can get some fake outs. But when all 3 of them flash at the same time, that seems to be a bit more reliable. But the winter-spring concept was interesting to me, so I wanted to take a look at how many of these stocks are in each of those, all 4 of those categories. So the next version does just that. It's just a count of how many are in each season. So you've got spring, summer, fall, and winter. And what we can see right now is interesting. We're below the 200, and this is the Dow. So we're below the 200, and we've got a declining 50 period moving average, and prices coming back up, and we have to see if it's going to climb above the 200 or reject. But you've also got this dense area of the volume profile. So this is selling pressure. Spring is on the incline, but we don't have participation from the summer category and our maturing trend. Remember, the fall is when we're in this type of motion where you're separating from the signal and the signal line, you're below it and you're approaching 0. So this is your mature trend rolling over. If we look at that, that's already kind of bottomed out, and the number of stocks in winter has hit one of the higher thresholds that we have. So, we can see what's happened in the past is if you were to have gone into the market on expansion in spring in March of 2025, while summer was not, while the summer measure had diverged from spring, so summer's still going down while spring is going up, that would have been a fake out, and you would have had to participate in the rest of this low, right? So what we really want to see is stocks start to, a majority of stocks start to get into this summer expansion, and that that comes after the low. So neither one is perfectly timed, but one is a much stronger indication of a sustained uptrend than the other. We'll take a look back at a couple. You've got a situation here where spring is expanding, it's diverging from summer, and then you get failed rallies into the moving average. That's what we want to avoid, and that's what this indicator is telling us to watch out for right now. It's saying, hey, you don't have enough stocks expanding into into a broader trend to get excited about this rally. So that's what it looks like with the Dow. Same with the S&P. So since it's for different seasonal categories for the same set of equities, we've got to have a different chart for each one. So here's the S&P. You can see the spring months are relative. The number of stocks in the spring category are relatively flat, while summer is declining, fall is declining, and winter is actually still expanding. So the Dow actually looks like we should be looking for summer to start to expand in the Dow, and winter to roll over. It looks like we'll probably start to see that from the Dow earlier than the S&P. So that's something to look out for. And then we'll take a look at Bitcoin. I actually wish I had come across this concept of separating them like this sooner, because it looks like if you enter a summer expansion in crypto, that's a strong buy signal, and then rolling over and going out of summer and into fall is a stronger sell signal, and that's because it's so speculative and volatile. But we can see that you've got you move into summer, and then summer rolls over, and that's your downtrend. And so you could kind of do that over and over. It's pretty nice. But the winter category is still expanding for crypto. We had a really steep spring, and this is not a very strong movement in price, right? Like Bitcoin's been one of the better performing over the last 2 months, but it's only been on a very slight incline from its lows in the low 60s, put in a high in the mid 70s, and is currently high 60s. So this is not a real strong movement, especially for this this type of speculative asset. But we had this big movement with the majority of these top 30 cryptos crossing over from downtrend into an early uptrend. Once we got the expansion with summer, and that cooled off, put in a lower high than it did back in January of this year, and then immediately get into like a cooling in the fall and an expansion in the winter. So tells us this is kind of a fake out, and we need to be prepared for a scenario where crypto has more selling pressure than we would like. So that's what it looks like with crypto, and then I want to take a look at a different way to use this, and that's with some of the risk appetite, equity headwind, and breadth metrics that I've been sharing recently. So I've got 3 tables here that I'm going to share. We've got breadth, and this is just a number of different ways to look at the number of stocks that are going up versus down. And it's color coding, so the bearish ones are negatives, so that they're inverted, and the color coding is applied consistently across all of them. And what we can see is breadth had its best performance. The number of stocks going up relative to those going down was better the last 3 days than it has been in the last 20. And at a weekly level, we closed the week with the most constructive look for breadth in the last 5 weeks. But it's still not as strong as other weeks that we have going back over the last 3 to 4 months. But this is what we start to see in recoveries: is the number of stocks participating in uptrends increases, and the number of stocks that are going down and making new lows should decrease. That's what should happen towards a low. The next chart compares different ratios of equities and equity ETFs to one another to suggest risk appetite. So, in a risk expansion, if participants are looking to take on more risk or getting comfortable with risk in the market, you'll see them do things like invest in emerging markets versus the S&P, go into transports instead of utilities. So these are 12 categories that I like the most for signaling risk appetite. And you can see they're in better shape than breadth is, and this is what happens near lows as well. You get participants are tired of the downtrend. They want to start jumping into the uptrend. They want to be early to the uptrend, and sometimes they're rewarded for it, and sometimes they're punished. But you've got your best perspective of risk appetite in the last 20 days occurring in the last 3 days of last week. And at the weekly level, it's, the better week for risk appetite, I'd say, over the last 5 to 6 weeks, but it's still really not great. It's definitely not the best week out of the last 4 months, but it's showing some signs of encouragement. And last are a collection of 12 things that I use to signal headwinds headwinds for equities. And so these are things that, correlation to volatility, to sensitivity to interest rates, preference for bonds. These are the types of things that, ratio of funds in U.S. dollar stable coins relative to the rest of crypto. These are things that I would take to be, if they're in a bearish complexion, an environment that's hostile for taking on risk versus supportive. And what's normal is for us to see, breadth improve, risk appetite pick up, and for that to front run, for those things to start to reverse before the equity headwind environment improves, and so sequentially, that's the way that we would expect to see it move, and in terms of headwinds, again, this is a better week than we've seen over the last 3 to 4 weeks, but it's not our best week out of the last 20 weeks. It's probably the best week that we've seen in about like 10 weeks, right? But it's still it's not great, and as far as the individual days looked good, but as far as the closeout for the week, it's still among these 3 to 4 worst weeks of the last 3 to 4 months. So the environment has not picked up as aggressively in terms of volatility, rate spread, as it has in breadth and risk appetite. Another way to look at that is, these indicators take all 12 of those metrics for risk appetite, headwinds, and breadth, and they're taking a scoring based on whether they're moving up and down, and the pace of movement and the amplitude of movement. And what we're seeing is exactly what we saw when we walked through those charts. The breadth is improved but choppy, and that's just the nature of breadth. But the risk appetite has shown the greatest improvement by crossing over, but it's not like a dense and sustained crossover yet, and the headwinds have not. They're just peaking above zero, but this is not a strong improvement in equity headwinds for us yet. Lastly, take the same approach that we did with the bottom fisher and break all of those different categories into seasons. And so I've combined 30 of them, and it includes half of the breadth measures, and all 12 of the equity headwind measures, and all 12 of the risk appetite measures. And we're doing the same thing that we did with the bottom fisher. Are you in winter? Are you in spring? Are you in summer? Are you in fall? And doing that, we can see we've got a big surge into spring, And just like the other equities charts that we looked at, we don't have the participation in summer yet. Fall is kind of bottomed out, but we are starting to see the winter period cool off, or the winter measure cool off for the equity headwinds, and that's favorable. But again, in the past, like we had in this April drawdown last year, we had a steepening spring. It diverged from winter, and we saw further downside, even though the number of headwinds that were favorable or unfavorable was declining. Right, it still was not a safe environment to be jumping into. So there's other examples where we can see that's when our failed rallies occur, is when we don't have the expansion of that summer category in these risk measures. Then we're not seeing a broad range of participation return to the market. So that's it on the current trend versus things that make me more pessimistic about the near-term outlook. And in terms of timing, we'll take a look at the Foundation for the Study of Cycles cycle app. And this is a composite cycle, and it's built with a 331-day moving average and an 80-period moving average. This has strong scores for stability and rank. Correlations okay at 50%. I've seen stronger when doing these, but so a couple of things to keep in mind when we look at cycle tools like this. The least meaningful piece of data is how high or low the cycle goes, and the most meaningful data that we can get from this is what dates are the pivots. And so the next pivot date that we have is April 17th, and that would suggest if we're headed into a low. So that, the most important information is the date. The second most important information is the direction. But cycles can invert, and sometimes an upward movement is really down. So you've got this pivot date back here in the middle of March in 2023 was actually, it looked like it was going to be a swing high. It was actually a pivot from a low, and that's what happens with inversions. And in this case, you actually had a trend acceleration at a pivot point. And so you have to be prepared for multiple scenarios. What's most important is that we knew that something was going to happen here. If we thought it was going to be a swing, we got faked out with a inversion, and it was really a move off of a low instead of a high breaking lower. So once you see that, okay, my cycle's inverted and I need to confirm with other technical indicators and participate. And then does that mean that this one's going to be different? And it turned out to be the case, and then we're back into a sequence where the indicator is directional again. And so again, we want to be prepared that the 17th is likely a date of interest, and that we could see a change in either the acceleration of movement in the market or the direction of movement. The next one after that is the 15th, or actually more like May 19th, and then we get into July 28th. So let's take a look at those real quick. There's the 17th, and we'll go out to May 19th, and then we said July 22nd. Right. And July 28th. And these will change based, because it's always incorporating new data. So that's one of the downsides of that composite line. It's hard. You have to take a snapshot of it each time. But let's say we were to get like a scenario that we work with here. Maybe we fail into this moving average and match the April low, and then retest in May, and then we have to see what the trend looks like from there. It's normal for us to see highs in especially in the technology space in the July timeframe before we get the cool down months in August and September. So maybe that's our scenario that we prepare ourselves for manually or mentally, is that maybe we swing back down into mid-April. Something similar in May, and then start to build into an uptrend in July, right? Like that's I could see that being a really normal scenario for us to retest and recover some of these moving average lines, and then we probably get a little bit more trouble in those summer cool down months, and then into the fall. Then we move into like a bullish phase in the fall and close out a bit more strongly for 2026. That's kind of a pattern with these moving averages that you've seen in other downtrends and recoveries, right? You fail into these moving averages, then you reclaim them. And so that's what our cycle tool is helping us to anticipate, is if that's a scenario that we're likely to see, then these are movements that I would start to look for around those time frames. And if we see something different, then it tells us that, if it's how we see it play out, then I know how to participate. If it's different, then it requires more research and more study. But that's what I see for now. If anybody has questions or comments, please feel free to reach out. But good luck in the market, and have fun.